How are we getting on, guys? Luke here from LAGFX. Today I bring you guys another Learn to Trade video. This is part 2 of support and resistance, our 3-part mini series that we have going on with this Learn to Trade. In today's episode, we are going to go over breakouts and how we can look to capitalize on the break and retest strategy. Now, if you haven't watched part 1 of this mini series, I definitely recommend going and doing so, just so you understand what support and resistance lines are. I also, within that video, show you exactly how to profit from rejection from these areas. And obviously in this video, we are going to look at how we can profit from actual breaks through these areas. So before we jump into examples and I show you exactly how to use this strategy effectively, it's important to understand that there is actually 3 different market conditions that we can implement this strategy with. So we have the ranging market, we have the trending market, and we have the counter trending market. Now, you might be wondering what these are. So what I will do is I will show you briefly now, and then we will talk about how we can actually, use these strategies and use these things to profit from the markets. So the first one is the ranging market. Now, it's quite self-explanatory, but it's basically when price is ranging between a level of support and a level of resistance. So it'll look something like this. So it'll tap into these levels of support and resistances, reject, and continue doing so until eventually there is either enough supply or enough demand to push the price through either the level of resistance or the level of support. Now, another thing we need to be mindful of when actually implementing this strategy into the live markets is that we don't get manipulated. This is a key part of this strategy, and it is not getting manipulated and not falling for failed breakouts. Now, you might be wondering again, how do we avoid, being manipulated and falling for that trap? And it's quite simply being patient and waiting for price action to come in, allowing other people to risk their equity. And then once the data has come in and we have evidence that price is moving in the desired direction, that is when we look to capitalize. Because at the end of the day, we don't actually know how much supply is above a level of resistance, and we don't know how much demand is below a level of support. So it is important, like I said, that we wait for other people to, buy and sell into the market, test those waters for us. And then as soon as we have confirmation, that is when we execute our position, and that is exactly when we profit. Patience is key in this game, and this is what we need to preach, and this is what we need to implement with this strategy. So when we talk about a failed breakout, if we were looking to sell into the market, if price broke below a level of support, some people might see that break and impulsively enter into the market, expecting the price to continue going down. Now, that, like I said, is being impulsive. They should wait for price to actually retest. So come back up, retest this level of support. We would then wait for price to reject that area. That in itself gives us more confirmation that price is going to continue bearish. And then as soon as we have a break below the low that it's set, that is our confirmation to enter into the market. Now, why? Well, in structural laws, in bearish structure, we see the lows get broke every single time, setting new lower lows, and we don't see the highs getting broke. So with that being said, this comes to, where would we place our position? Obviously, where would we enter? Where would we place our stop loss? And where would we place our take profit? Well, as soon as we have that rejection from the level of support, which is now acting as a level of resistance, we could have a pending order waiting to be activated. We would have our stop loss above this, lower high that it's gone on to produce, rejecting that level of resistance. That is now a structural lower high. And then we would have our take profit where we sees fit. Now, the exact same thing applies to a bullish market and a breakout, from a level of resistance. So price would trail up, it may consolidate slightly, eventually break through. Rather than jumping in and being impulsive and price actually reversing, producing a failed breakout, we would wait for the rejection from that level of resistance, which is now acting as a level of support, and then we would enter in on our position. So it would look something like this. Price would trail up, it might consolidate around this area, eventually break through, come back down to retest that level of resistance, which is now acting as support. And then as soon as we see price go on to start set new bullish structure, as soon as this high that it's created has been broken, that gives us confirmation that bullishness is continuing, because in bullish structure, we see higher highs and higher lows being set. The highs get broke every single time and the lows don't. So this high has been broken. That's our confirmation. Yeah, it's going on to set a new higher high. So we could set a pending order here, jump on the trade with our stop loss below the low that it sets, or below the level of support, which was originally resistance. And then we would have our take profit set where we see fit again, ensuring we are using good risk to reward ratios. So the first and biggest tip that I can suggest to you guys when using this breakout strategy is to be patient. Wait for that confirmation. Yes, you might want to impulsively place a position as soon as you see that breakout and you see price continuing to trail up or down, but be patient. Wait for price to retest, come back to tap into that area, show signs of rejection, and then look to place your positions as soon as we see those structural highs and lows being put into the market. So moving on to the second market condition, we have a trending market. So how would we look to capitalize on a breakout from a trending market? Well, we've just been speaking about structural highs and structural lows, and how in bullish structure, we see higher highs and higher lows being put into the market. And in bearish structure, we see lower highs and lower lows being put into the market. Now, when price approaches a level of resistance in a bullish trend, we can expect that once price has actually approached this area, we may see consolidation take place, but as long as we are seeing a continuation in those higher lows being put into the market, that is still telling us that the demand is building. And eventually what we can expect to happen is that demand that is being put into the market, so those buy orders that are being put into the market, are going to outweigh the supply that is waiting above this level of resistance. So when price breaks through, it shouldn't produce us with a failed breakout. We can expect price to come up, come back down and retest, and then go on to set bullish structure. Now the opposite applies to a bearish trend, so a bearish trend in market. So we would see lower lows and lower highs being set into the market, and then as soon as it approaches a level of support, we can expect some kind of consolidation, but assuming it continues to put in lower highs, that still gives us that confirmation that supply is being put into the market, and eventually it is going to outweigh the demand that is waiting underneath the level of support. Once it breaks through, our support line is now acting as a level of resistance. Price will come back up to test this area. It should reject, and then we can look to enter in on our sell positions, and we would have a continuation in bearish structure. Now, the reason why price consolidates when it gets to these areas of support and resistance is because the markets are basically undecided. There isn't enough supply or demand in the market to push it in one direction, hence why we have that consolidation. But like I said, in bullish structure, if when it does consolidate, it continues to put in those higher lows, we can expect, and that tells us that there is more demand being put into the market than there is supply. Eventually, it's going to outweigh and push the price up and above, and then the opposite would apply for a bearish market. Now, what happens if we aren't seeing these higher lows being put into the market, and we're not seeing the lower highs being put into the market for this bullish and bearish structure? Well, that tells us that price could potentially be looking to reverse, in which case we would just again go back to our tip number one and be patient, wait for the right confirmation, and look to take advantage of a reversal from these points rather than a breakout. So we've got two tips now. Number one is be patient. Patience is key. Allow other people to risk their equity, allowing us to see more data. As soon as we have the right confirmation, then we can execute our positions. Tip number 2 is keep an eye on the structure of the market. Is it putting in those higher highs? Is it putting in those higher lows? What is the structure of the market telling us? Because that will tell us exactly how much supply and demand is in the market. From that, we can decide and we can dictate whether we believe we are going to see a breakout, or we're going to see a failed breakout, or just a clean rejection. Now, the last market condition we can look to capitalize on a breakout is actually a counter trend market. So in bullish structure, we expect higher highs and higher lows following a nice trend line. As soon as we see a break below this trend line, that is our first piece of confluence that price could be reversing, going on to now set new bearish structure. Again, like the other two market conditions, we would wait for confirmation by getting that rejection once we have the retest. So does price come back to tap into this area to then continue this bearish structure? If so, we would look to enter as soon as we have a break below the low that it's set. So we could execute here. We could ride the price down and we can expect bearishness to continue. Now, alternatively, in bearish structure, we see lower highs and lower lows being set following a trend line. Once we have a breakout, we would wait for the retest, price to come back down, tap back onto this trend line, which was once resistance and is now acting as support. If we see price come back up, reject that cleanly, we see a break in the high that was set, we can then look to buy into the market. Now, again, we need to be extremely careful that we don't get manipulated. So we don't want to impulsively place our positions. We want to wait for price to come down, come back up and retest, and then go on to set bearish structure. That's when we'll enter, because what could happen is we could have the initial breakout, but price could then come back up and start respecting that trend line once again, continuing that bullish structure. This would be the failed breakout, and this would be the manipulation, and that is exactly how you would lose in your trade. Now, one thing to keep in mind when drawing out these trend lines, and I'll go over this in greater detail in the next episode, is when you are drawing these trend lines and these channels and these ranges, it is important that you have at least 3 taps. Otherwise, the trend line you have drawn is invalid. So just to show you guys an example, this is obviously bearish structure. So we would draw our trend line above the structure. We have a tap here. We have our second tap here. And we have a third tap here. So this would be a valid trend line. And we could look to capitalize on the 4th tap here. And as you can see, price has played out beautifully. Now, again, looking at bullish structure, in order for the trend line to be valid, we need at least 3 taps. So we've got tap 1, tap 2, tap 3. This is now a valid trend line. We could then look to enter in on a long position here. Now, again, I'll go over trend lines and channels and validating these lines that you draw out in the 3rd and final episode of this mini series. But I hope you've enjoyed this video, and I hope you understand now how to, profit and trade these breakouts, when to actually execute a position, what you would be looking for, and the evidence you need. And I hope you take advantage of the tips that I've given you. So to sit on your hands, be patient, wait for data to come in, allow other people to risk their equity. And as soon as you have the right confirmation, then look to enter into the market. And tip number 2, look at the structure of the market, familiarize yourself with structural highs and structural lows. Now, if you have enjoyed the video, please leave it a like. Every bit of feedback, every bit of support is very much appreciated. If you are still unsure about anything I've gone over today, I can make another video going into greater detail on each specific market condition. If there is one that you are still unsure about, please just let me know, put it in the comments below. But yeah, I hope you guys have enjoyed. It's been a pleasure. This is something that can be implemented into your everyday trading strategy. This is a skill and a way of reading the markets that is worth knowing. no matter what your trading plan or strategy is. You know, breakouts and failed breakouts are great ways of looking at price action. This is more of a traditional way of a technical trader's analysis. You know, this is the style of trading that actually founded my success within this industry. Obviously, over time, I have adapted and implemented other things, but this is just another tool to add to your toolbox, you know, and more knowledge that you should acquire within trading. I think you are always a student in this game, and it is very important to constantly be learning and finding new ways of tackling the markets. So I just want to say a massive thank you guys for watching, and I'll catch you guys in the next Learn to Trade video.